Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street, delivered right after the closing bell. Please note this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in. So, looking at November 5th, if you just glance at the headlines, you might think, okay, decent day. S&P 500 up 0.37%, NASDAQ gaining 0.65%.
Right. Looks pretty constructive on the surface.
But that's really deceptive, isn't it? It feels like today was a real study in extreme divergence, masking some serious weakness underneath.
Absolutely. That headline game, honestly, it's a bit of a red herring today. The real story, and I think the key thing for you listening, is figuring out how the indexes can be up when, well, most stocks were actually down.
Okay, so let's break that down. You mentioned market breadth was really poor.
Yeah, I mean, it was one of the worst breadth readings we've seen this year, 2025, especially relative to how the S&P actually performed.
What does poor breadth actually look like in number?
Well, get this. More than 80% of the stocks in the S&P 500 finished lower today. That's over 400 companies in the red.
Wow, 80%.
And on the NYSE, decliners swamped advancers, 1,783 to 793. If you look at the volume, almost 69% of the trading volume was in stocks that were falling.
So it really wasn't a broad rally at all. It sounds like just a few big players were doing all the heavy lifting.
That's exactly it. It's a classic concentration risk scenario. And another number that really jumps out is that less than 38% of S&P 500 stocks are even trading above their 50-day moving average.
Less than 38%.
Yep. It really suggests that market participants are kind of hiding out in maybe, 5 to 7 mega cap names. That's the kind of pattern we saw, back in late 2021, historically associated with peak risk.
Right, just before that correction. So you wonder how long those few giants can keep propping everything up. And I guess that showed up in the sector performance too.
For sure. Technology, the XLK, and consumer discretionary XLY were really the only games in town.
And Tesla's a big part of XLY, right? Yeah. It had a strong day.
It did, yeah. Tesla surged almost 4%. Seems like folks are positioning ahead of that shareholder meeting on Thursday about Elon Musk's pay package.
Okay. And what about the losers? Which sectors lagged?
Well, it was the more defensive areas like industrials and utilities. They lagged quite a bit, which again, when defensive sectors are weak while the index is technically up, it sort of signals a very fragile, very selective risk appetite.
Makes sense. Speaking of tech, we should probably touch on Qualcomm. They reported after the bell, beat estimates, but the stock fell. What happened there?
Yeah, that one was a bit confusing on the surface. Operationally, they did great. EPS came in at $3 versus the $2.88 expected, so a solid beat.
But the stock dropped anyway.
Right. The issue was this huge non-cash charge, $5.7 billion. It relates to something called a valuation allowance against U.S. federal deferred tax assets.
Okay, let's simplify that a bit.
Basically, it means they're writing down the value of a potential future tax break. They decided it's less likely they'll actually be able to use those tax savings down the road, so accounting rules say they have to book a sort of paper loss today. It's a big accounting hit that just overshadowed the good operating result.
Got it. A reminder that accounting can definitely move stocks, even with good underlying performance. Okay, let's shift gears, because while stocks were, narrowly positive, the bond market was doing the exact opposite, selling off sharply.
Yeah, complete divergence. Yields popped higher pretty much across the board. The 10-year Treasury yield, for instance, jumped about 6 basis points up to 4.159%.
What was pushing yields up so much?
Two main things, really. First, we got some stronger than expected economic data. That tends to reduce the perceived need for the Fed to cut rates anytime soon.
What data specifically?
The ADP private payrolls report showed businesses added 42,000 jobs. That was quite a bit higher than the 22,000 people were expecting. And the ISM Services Index, that rose to 52.4%, also beating the forecast of 50.5%. So economic resilience.
Okay, strong data, higher yields. That's kind of the textbook connection. But was there something else going on? You said two things.
Yes, the second catalyst was arguably more significant, and it came from the Supreme Court. They held a hearing today on the previous administration's tariff authority.
The Trump tariffs.
Exactly. And the justices sounded, pretty skeptical about the legal basis for imposing those tariffs using emergency powers. Justice Sotomayor actually said, quote, "You say tariffs are not taxes, but that's exactly what they are."
Oof. That sounds like it could have huge implications. What's the potential fallout?
The big one is fiscal uncertainty. If the court rules against how those tariffs were implemented, the government might potentially have to return something like $151 billion in duties that were collected just in the second half of fiscal 2025.
150 billion. That's a massive, sudden budget hole.
Precisely. And that risk put immediate pressure on Treasury prices today, pushing yields higher. Bond investors do not like that kind of fiscal uncertainty.
Makes sense. And how did this volatility play out in, say, corporate bonds?
Interestingly, corporate credit spreads, especially in high yield, are still incredibly tight. They're near multi-decade lows, actually, around 281 basis points over Treasuries.
So, despite the Treasury wobbles, the corporate bond market isn't showing much stress yet.
Not yet. It suggests corporate balance sheets are still seen as pretty robust, but it also means there isn't much of a cushion if things like this potential fiscal shock actually start to go wrong.
Okay, one more rate-related thing. Real estate investment trusts, REITs, they're usually sensitive to rates, but they barely moved today despite the Treasury sell-off.
Yeah, that was notable. REITs were basically flat. It kind of suggests the market might have already fully priced in that higher for longer rate narrative for that sector.
But what about mortgage rates?
Good point. While REITs might be looking past it, this jump in the 10-year yield probably means that recent dip we saw in mortgage rates, the 30-year fixed, had fallen back to around 6.08%. Yeah, that decline is likely to reverse course pretty quickly now.
Okay, so we've got shaky leadership in stocks, rising yields in bonds. Where does that leave crypto? It felt like outright distress over there today.
Total distress is probably the right description. I mean, the scale of the breakdown was pretty historic in some ways. Bitcoin plunged right through that huge psychological $100,000 level.
First time since June, right? That's a major technical break.
It really is. It managed to stabilize just above it, around $100,870 by the close. But yeah, breaking 100K is significant.
What caused such a dramatic drop?
It looks like a massive leveraged unwind. We saw total liquidations hit $2.1 billion over 24 hours. That's mostly people who were betting on prices going up being forced to sell.
Forced selling, $2.1 billion. Wow.
And adding to that pressure, you had institutions pulling back. The U.S. spot Bitcoin ETF saw another $577 million in net outflows. That makes 5 straight days of redemptions.
5 days. How much is that in total recently?
Over the last 4 trading days alone, it's about $1.3 billion leaving those ETFs. That's a significant retreat.
Definitely sounds like a shift in sentiment. Does this tie back to the Fed and rates too?
I think it does. You know, expectations for a December rate cut have been coming down, especially after Chair Powell sounded a bit more cautious recently. Today's strong data didn't help either. That removes one of the key arguments that was supporting speculative assets like crypto.
And the dollar. Didn't that strengthen today as well?
It did, yeah. The dollar index, the DXY, climbed to 100.1. That's its highest point since back in May.
And a stronger dollar tends to be a headwind for, well, for things priced in dollars, right?
Exactly. Like commodities, WTI crude oil was down 1.6% today, partly because of that dollar strength. And it certainly doesn't help cryptocurrencies either. It makes them more expensive for buyers using other currencies.
Okay, so it feels like a really fragile setup across the board. Strength on the surface in equities, but driven by so few names, while bonds and crypto are flashing warning signs. What should we be watching in the weeks ahead? The government shutdown seems like a big wild card.
Absolutely. The shutdown is causing major headaches, especially for economic data. Key releases like the official jobs report, the CPI inflation report, they're suspended. The White House even hinted the November CPI data might just not be available on time.
Wait, so the Fed might have to make its December rate decision using only data through September?
It's looking like a real possibility. That's an unprecedented situation for a Fed that always says it's data dependent.
Yeah.
How do you depend on data you don't have?
Like, it's a huge uncertainty. How are market participants thinking about potential scenarios now? What's the sort of base case?
Well, the base case, maybe a 50% probability right now, is that things kind of muddle through while we wait for clarity. So the S&P 500 chops around, say, between 6,700 and 6,850. Treasury yields stay in maybe a 4.10 to 4.25% range. And Bitcoin tries to consolidate between $98,000 and $105,000. Basically a holding pattern.
But given everything we've talked about, the concentration, the Supreme Court risk, there's definitely a bearish case too.
Oh, for sure. And it's not insignificant. If that Supreme Court ruling does create a fiscal crisis, forcing that $151 billion refund. And if the odds of a Fed rate cut keep falling, maybe down to only 30–40%,
Then what happens?
then you could easily see the S&P 500 correcting down towards the 6,600 or 6,700 level. And in that kind of scenario, you'd almost certainly expect those super tight corporate credit spreads we mentioned to start widening out, signaling more stress.
So a lot hinges on these external factors, the
Yeah.
court, the shutdown, the data we don't have.
Exactly. And it brings us back to that breadth issue. The big question to leave you thinking about is this. Historically, can equity markets really sustain record highs when less than 38% of the main index components are even trading above their 50-day moving average? History suggests that's a very tough ask.
That's a powerful thought to end on. Definitely highlights the underlying tension in this market. That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.